Hey guys, it's Gray from Wattle Accountants. Today we're going to talk about a common tax planning strategy for small business, and that's paying a wage to your spouse. So firstly, how does that work? If you take an example where you have a business and you have $100,000 of income, your spouse has no income, they don't work, and if you were to pay tax on the $100,000, it may be a lot of money. I think it'll be about $39,000 for an individual. If you paid a wage to your spouse of say $50,000, your taxable income will go down to $50,000. They will also then have $50,000 of taxable income. Overall, the tax rate will be lower because the income tax rates are stepped. Pretty simple strategy, right? But what do you need to be aware of if you're going to go ahead and do this? So the big thing is actually whether it's considered reasonable. So if we look at the Income Tax Act 1997, so we can see here with this paragraph 2635, it talks about where there's reductions for amounts paid to related entities. So you'll see under paragraph 1, which talks about if it's incurred for some other reason in the Act, then it will be deductible. Otherwise, the amount is reduced by what the Commissioner considers as reasonable. So it's not what you consider is reasonable for what you chose to pay them, it's what they consider as reasonable. So a good example would be two scenarios. So one is a family-run fish and chip shop, mum, dad work in the business. They would look at that and say, whatever the wage is there, it would have to be reasonable for what someone would do there. They would also need evidence that they're actually there. They could even interview witnesses, you know what I mean? It's, you need evidence to prove that that's the case if they audit for that. Or they believe you're trying to divert your income. The reality, it's going to be straightforward in that scenario. There wouldn't be any issue because they are working in the business. However, the second scenario, which is very, very common, where you'll have a consultant that will work through a company or trust, they have sort of very high income, or they're a tradesman, they have, sort of very good income as well, and their spouse doesn't work. What happens in that situation is usually they will say, they do admin work or that sort of thing. The reality is they're not actually working in the business, and there would be no evidence, there's no email trails, people don't know who they are in the business. Another thing would be considered is what you're paying them. You don't pay an administrator $100,000 wage if you're trying to split $100,000. They'll say, well, if she really is a receptionist, why are you paying $100,000? If you went out to the market and were trying to fill that position, you wouldn't pay them $100,000. So in that situation, if they deemed she is working in the business, but it's not $100,000, they may deny, half of the wage or something like that. So now that we understand how it works and what to be aware of, what happens if you have this arrangement and it's not reasonable? So very simple, the ATO would deny your deduction. So if you had $100,000 of income and you had a deduction of $50,000 as the wage, they would deny the deduction. You would have to pay the tax back because usually it would be post the fact. So you would have got a lower tax payable because of the deduction, and now you have to pay the tax back. So in that situation, not only will you have to pay the tax back, usually because it's considered tax evasion, it's up to 75% of the amount. So if the tax shortfall because you claimed something and they deemed it wasn't deductible and the tax was $10,000, you now need to pay $17,500, and there's interest compounding daily on that. So obviously not great. And then I guess the double whammy here is usually when the audit, it can be it could be years later, and your wife has lodged her return with the $50,000 income in there as well. Unfortunately, you can no longer amend it because you're past the due date. You only have a 2-year, usually 2-year for a personal. So in that situation, not only do you not get the deduction, you also have the fine, the massive penalty, you've got the interest, and then you've paid tax again on that money, even though you didn't get the deduction. So very dangerous. Make sure you do your planning right. You've got proper documentation. You've talked it through with your accountant. It's not as simple as just saying, let's pay $50,000 to the spouse to lower your tax. If you haven't talked through the scenario of how under an ATO audit it would be defended, I would look for a new accountant immediately. And yeah, so if this video has been insightful, It's just one of many tax planning strategies small businesses use. It can be used effectively, if done correctly. But yeah, if you're in this situation and you're covered, that's great. But if you looking for a second opinion, we're always happy to help. So if you like the video, give us a like, leave us a comment, and yeah, thanks for watching, and we'll see you at the next one.